Every chart is quietly telling you two stories at once. The top story is price, the line everyone watches, the record of what happened. The bottom story is volume, the row of bars most beginners ignore, and it is the conviction behind every move. Today you learn to read a chart the simple way, by listening to both stories together, because price tells you what the crowd did, but volume tells you how much they meant it. Once you can read the two as one, charts stop looking like noise and start sounding like a conversation. Let's begin with what volume actually is, because it is wonderfully simple. Volume is just the number of shares that changed hands in a given period, a day, an hour, a single candle. Every share traded means one person was convinced enough to buy and another convinced enough to sell. So a tall volume bar means a loud, crowded argument, lots of people taking sides. A short volume bar means a quiet day, few people bothering to trade. Think of volume as the fuel under the price, or as the size of the crowd cheering a move. A price move on heavy volume has a crowd behind it. The same move on thin volume is almost talking to itself. There's an old and useful way to frame this, from a trader named Richard Wyckoff, who studied the market a century ago. He spoke of effort versus result. Volume is the effort, the energy spent, and the price move is the result you get for that effort. When a big effort produces a big result, the move is honest and likely to continue. When a huge effort produces only a tiny result, something is wrong. The move is meeting hidden resistance. That single idea, effort against result, is the heart of reading volume. Now let's make it concrete with the 4 combinations you will see again and again. Memorize these, and you're most of the way there. Combination 1. Price rising on rising volume. This is the healthy one. The advance has real demand behind it, more buyers piling in as it climbs, and that is the footprint of a trend you can trust. Combination 2. Price rising on falling volume. This one should make you cautious. The price is drifting up, but fewer and fewer people are participating, like a balloon losing air. A rally nobody is joining often runs out of buyers and rolls over. Combination 3. Price falling on rising volume. This is real selling, sometimes called distribution, where the crowd is rushing for the exits and heavy volume confirms the fear is genuine. A downtrend backed by swelling volume deserves respect, not bargain hunting. Combination 4. Price falling on falling volume. This is the gentlest decline, where the selling is drying up, fewer sellers left each day. It could be an early hint that a bottom is forming, that the sellers are simply getting exhausted. Up on volume, healthy. Up without volume, suspect. Down on volume, dangerous. Down without volume, exhausting. For pictures, and you can read most charts with them alone, volume earns its keep most clearly at one specific moment, the breakout. Remember from earlier episodes that a breakout is when price finally pushes through a resistance ceiling or support floor. The single question that separates a real breakout from a trap is, did volume show up? A breakout on a big surge of volume means the crowd genuinely committed, and it tends to hold. A breakout on quiet, limp volume is the classic fake out, where price pokes through, no one follows, and it sags right back. This is why seasoned traders almost never trust a breakout that volume did not confirm. This rule is not new. More than 100 years ago, Charles Dow, whose ideas became Dow theory and gave us the Dow Jones Index, laid down a principle we still use. Volume should confirm the trend. A healthy uptrend, Dow observed, shows higher volume on the up days and lighter volume on the pullbacks. When that relationship flips, when rallies go quiet and declines get loud, the trend is weakening under the surface, even if price is not turned yet. Volume often whispers the truth before price admits it. That whisper has a name, too. A trader named Joseph Granville built an indicator called on-balance volume, which simply adds volume on up days and subtracts it on down days to track whether buying or selling pressure is winning. His famous claim was that volume precedes price, that the crowd's commitment shifts before the price chart shows it. You do not need the indicator itself to use the wisdom. Just watch whether the big volume bars are clustering on the up moves or the down moves, and you are reading the same story. There is one more pattern worth knowing, the volume spike, sometimes called a climax. Every so often you will see one volume bar tower far above the rest, 2 or 3 times the normal size. That is the sound of panic or euphoria reaching its peak. A giant spike at the bottom of a long decline often marks capitulation, the moment the last frightened seller finally gives up, and it can mark a turning point. A giant spike at the top of a long climb can mark exhaustion, the last excited buyers piling in just as the move runs out of room. Extreme volume marks emotional extremes, and emotional extremes are often where trends end. One practical note before the example, because new traders always ask it: what even counts as high volume? The answer is never an absolute number. It is always relative to that stock's own normal. 1,000,000 shares might be a sleepy day for a giant like Apple and a wild frenzy for a small company. That is why most charting tools draw a moving average line across the volume bars, showing the recent typical level, so you can instantly see whether today's bar is above or below average. Read volume against its own history, not against some universal figure, and the 4 combinations suddenly become easy to spot. Let's walk one quick example, so the 4 combinations stop being abstract. Picture a stock that has drifted sideways for weeks. Then one day it jumps 4% and closes near its high, while its volume bar is the tallest it has shown in months. That is combination 1 in its strongest form, a breakout with the crowd behind it. And it is exactly the kind of move that tends to keep going. Now, picture a different stock that climbs gently for 2 weeks, a little higher each day, but its volume bars get shorter and shorter the whole way up. That is combination 2, a rally quietly running out of fuel, and a calm reader would tighten their guard rather than chase it. Same green candles on the screen, 2 completely different stories, and only the volume told you which was which. That is the whole point of learning to read the bottom of the chart. Now, a gentle warning, so you keep this in proportion. Volume is a powerful clue, but it is still only a clue, not a crystal ball. Plenty of moves break these tidy rules, and reading volume, well, takes practice and a feel for each particular stock's normal rhythm. The goal is not to predict the future with certainty. It is to add a second opinion of price, so you're a little less likely to be fooled by a move with nothing behind it. Used that way, volume quietly improves almost every read you make. And so we return, as we always do, to the honest truth. This skill of reading price and volume together is genuinely useful, and it is the real craft of the chart reader. But it is also one more thing to learn, watch, and second guess, and it is not required to build wealth. For most people, a broad, low-cost index fund bought steadily, month after month, captures the long rise of the whole market without ever reading a single volume bar. That calm, boring path has outperformed the great majority of active traders, and it remains the wise default for nearly everyone. So look again at any chart, and remember the 2 stories stacked on top of each other. Price tells you what the crowd did, and volume tells you how much they meant it. Learn to read them as one conversation. Watch for volume to confirm or quietly contradict the price, and you will see things most people staring only at the line will completely miss. I'll see you in the next one. Until then, keep it simple, and remember, a move without volume is just a rumor, while a move with volume is the crowd telling you the truth.